Welcome back. It's all about asset allocation, and with us here is Ken Kaniu, who is the CEO of Britam Asset Management. Welcome, Ken.
Thank you, George. Thank you, Bida.
And Ken, it's all about asset allocation, obviously.
That's
but
right.
How do you deliver alpha in the second half of the year? We've just talked about, a brief chit chat with Bida. We've talked about the market, the stock market being at a 10-year low, and specifically the benchmark 20 index being at a 10-year low.
Right.
And just wondering if asset prices, is this a trend? If other asset prices are going to pick up this downward trend, then how do you deliver alpha for your clients in the second half of the year?
Great, and thank you for that question, George. I think our sense at Britam Asset Managers is that this looks like the new normal.
Yeah.
To that extent, the equities market has been very volatile.
Yeah.
In fact, it's been negative in 3 out of the last 4 years.
Yeah.
So truly, for a lot of our customers who have then held on to equities during that period, they have in fact earned less than they would have earned had they then invested into fixed income securities.
Yeah.
And we expect that trend to continue because we don't really see the catalyst out there in the horizon that would then cause a re-rating as far as the stock market is concerned.
Yeah.
I think the biggest trend that we've seen persisting has been interest rate caps.
Yeah.
And that has simply served to dampen private sector credit growth, and in turn has really kind of diluted, let me call it private consumption.
Yeah.
So truly we've been led by government consumption. So I think for those kinds of investors who've been investing into equities, I think they've been well advised to then invest into defensive type equities.
Yeah.
Companies which can act as a good store of value and maintain their value. And I think to that end we've then begun to see, dividend yields then begin to rise. And I think the current dividend yield in the market is 5.2%,
Yeah.
which is above the historic dividend yield that we've seen of 4.4. So truly, for those defensive companies, they are not seeing much by way of reinvestment opportunities, so they're choosing to return that cash back to investors.
Yeah.
I think for a new investor who's looking to build a new portfolio into equities, this is a great time. Because I think, as you've mentioned, prices are at an all-time low, 10-year low. If you look at price to earnings multiples, the PE ratio today is at about 11.5 times. And this is very low compared to the 5-year average of about 13.6 times.
Yeah.
So truly, in terms of an entry multiple, in terms of timing, in terms of someone who wants to construct an equity portfolio now into the future, this is a great time to actually participate in the market. But for those who sort of bought in 3, 4, 5 years ago,
that's
it's tough times.
It's a tough time.
It's tough times.
Okay.
Yeah. It's tough times. Yeah.
But I like the element of a defensive strategy. Do you have any particular stocks you think would perfectly fit into this kind of strategy?
I think it's the well-known names.
Okay.
I think it's what I would call the top 5 stocks by market capitalization.
All right.
Those tend to be the ones that have done fairly well. So sort of the Safaricoms of this world have done fairly well. The banks have proven themselves to be fairly resilient, even in the face of interest rate caps and changes in terms of accounting regime. So if you look at what IFRS 9 was supposed to mean for banks, I think we have struggled to see what I would call real impact from the point of view of earnings trajectory and so on and so forth.
Okay.
Some of the utilities like Kengen are doing extremely well, executing projects on time.
Okay.
And on budget. So I think those tend to be the companies that one would then look at.
Okay.
Yeah.
I also like the way you've broken it down and said, okay, fine, if you're potentially looking to start creating a portfolio at this point in time, it's a good time to get into equities. If you've already been there, maybe not so.
That's right.
What does that mean in terms of balancing equities and fixed income for a new person who's starting to invest?
No, that's right. I think what's happened is that, we've spoken about equities. I think fixed income over the last 1.5 years has done extremely well.
Yes.
Again, driven by changes in the, let me call it, monetary policy space. So again, if you've seen what's happened with interest rate capping, a lot of banks have chosen to allocate their excess liquidity into government securities.
Yes, they have.
And this has had the impact of really lowering interest rates. So for a lot of fixed income investors, they made a lot of money.
Okay.
13, 14, 15, 16% has not been unheard of. So the current question is how much further can interest rates trend downwards?
All right.
I think for now we lack then the catalyst to then see them rise forwards in the absence of a repeal or a removal of the interest rate capping regime.
Okay.
So now interest rates are look a bit stable to be honest.
Look a bit stable.
I don't see them plowing down further. I don't see them losing another 1 or 2 or 300 basis points. but I don't see the catalyst driving them upwards.
But maybe just to interject on that, because I know Parliament is actually having the second reading with regards to the finance bill and going back and forth on whether they're going to accept the amendments on the rate cap. I think it goes through the second reading, then after that it has to go back to the committee stage before it comes back for a thorough debate in the House. What potentially happens if this rate cap, for example, is removed? What does that mean for the fixed income assets?
I think if the rate cap is then removed, you'll then begin to see banks want to take on board more risk assets, which is in summary lending to companies and individuals.
All right.
So you should see loans which have been disbursed now beginning to get disbursed, and you should see to some extent more flexibility and more of an appetite to then obviously process new credit applications.
Okay.
So you will begin to see some pullback away from bonds and to allocate that money more towards, let me call it assets or bank assets, which in summary is loans.
All right.
And that might have the impact of causing rates to begin to trend upwards.
Okay.
It's currently felt that if you look at a 10-year bond that close to 10%, really is that reasonable?
No,
and
it's
so
not.
on and so
It's
forth.
certainly
5-year way below.
Exactly.
And I know I said earlier that this is a great time to build an equity portfolio, but this is in fact not the right time to then build a bond portfolio, because you don't build a bond portfolio when rates are down.
Okay.
You're supposed to build them when rates are up.
When rates are up.
So for new investors, it's very easy to get caught out. And I do recall, I think it was in 2003, 2004, 2005, we had 10-year bonds with coupons of 7%.
Wow.
We had 5-year bonds with coupons of 5%.
Wow.
And you may have bought it at 5% and done very well in that particular auction.
Yes.
But 2 years later, you look like you don't know what you're doing. And the next 5 years then comes out at 10% and so on and so forth.
History.
Massively
That's right. So it's very important to be able to, massively underwater. So it's very important to be able to look back and figure out what are the trends, what do I need to do, how do I learn from history, and how do I take advantage of truly these macroeconomic cycles to profit for the benefit of your customers.
Fantastic.
So it's not just about dumping money into these things. But the big debate now is about alternative investments.
Okay.
Now that equities are performing as they are, and fixed income is performing as it is, the next frontier is alternative assets, and perhaps at some point we can get an opportunity to chat a bit more about that.
Okay.
Yeah. I'm still on this fixed income story. It looks very interesting for me. I mean, if I strip off the element of interest rate cap being removed, because I honestly don't see it being removed, but that's my argument. If you look at the underlying macro fundamentals, the MPC met about 2 weeks ago, and they raised the caution, actually issued a vigilance against the impact of fuel price adjustments feeding into consumer prices, and we've seen that with the July inflation numbers going up. So that on the inflation side, it looks like we're up for some uptick. And if you look at, apart from inflation number, if you look at our the government fiscal operations, obviously last fiscal year 2018-2019, government did not fail to meet its collection targets. And if you look at the current fiscal year, it looks the spending plans are very ambitious. We're running up huge primary deficits. It points to me that the current downglide in interest rates is a bit artificial for me. Do you share the view that at any point that interest rate could just start shooting up anytime and leave most portfolios under the water? Are you very worried about the prospect of interest rates going up?
I think whilst I think what you said is reasonable and so on and so forth, I think for us the big catalyst is interest rate cap itself. The fiscal deficit, by all accounts may have even doubled over time.
Yes, it has actually.
Look at sort of the government loan book.
It's quite crazy.
It's crazy.
Yeah.
I think if you look at the statistics, with the current regime, they in summary have doubled, if not tripled, what they then sort of took over.
Yeah, actually, they're actually almost, because when they took over in 2013,
absolutely,
total public debt was about 2 trillion Kenyan shillings.
Absolutely, yeah.
Now we are talking about, as a June, it was 5.8 trillion shillings. This is 3 times.
No, absolutely, absolutely. I think the point I was making is that even as that has happened, we've still seen inflation remain fairly well managed.
Yeah.
I don't think within the last term of the previous governor, when all this debt was then being piled on, we then used to talk about inflation. We never used to talk about inflation. So to that extent, it's not as much as a worry as what we'd worry about as inflation brought through from, let me call it, food price increases, food increases as well. I think that's possibly the thing that we're watching for. And we're in a fairly political environment. On one side, we are told we have a drought. On another side, we don't. On one side, we need to import 10 million bags of maize. On another side,
it's a host
is 2.
So
sometimes it's difficult to actually get the right information that you can then use to make a decision.
Yeah.
But in as far as food prices and fuel prices are concerned, those are on the uptick. But I think we've all seen with the MPC and certainly with the central bank, their main focus is on non-food, non-fuel inflation.
Yeah.
They don't tend to care too much about overall.
The headline inflation.
Yeah, headline inflation.
Okay.
Yeah.
All right, great. So we just have to update our viewers. The market is closed. It's past just a few minutes past 3 and the market closed. We'll update you on the numbers shortly. But getting back to our discussion, you mentioned about alternative asset classes, which is very, very important.
Right.
And I look at you as an asset manager, I look at your current existing mandate.
Right.
How much discretion do you have in terms of your pension portfolio in going to asset classes, or are you much do you see a lot of restrictions coming from your trustees?
Right. I think everybody is beginning to recognize, and not just us as Britam asset managers, but we're all beginning to recognize the importance of allocating funds into alternative asset classes. If you look at the retirement sector as a whole, assets there have tripled over the last 3 years. Sort of gone from let me call it 400 billion shillings, let me call it 7 years ago, to 1.2 trillion shillings today.
What's driving that? That's impressive performance for the last 3 years.
That's right, yeah. So it's more pension contributions, it's more employees coming on stream, it is wage increases.
Wow.
It is employers beginning to set up pension schemes and so on and so forth, which I think is great. But we haven't seen the growth in the capital markets then match the growth in those liabilities. So during the same period, the stock market, the number of companies listed in the stock market has remained exactly the same. We still have the one government bond issued every month. In fact, if you look at corporate bonds, we are moving in the wrong direction rather than in the direction of more issuances. So the challenge becomes what to then do with the money, because if you plow everything into equities, you'll end up sort of driving prices up, not because of fundamentals, but because you're chasing an allocation.
Yeah, so much money chasing single asset.
That's right. Same for bonds as well, which is part of the reason rates have gone down, not because we are doing well, but because it's just too much liquidity chasing the same asset.
Yeah.
So I think the RBA, which is really our regulator, the Retirement Benefits Authority, has also made amendments to the investment guidelines that we then use to then allocate investments and so on and so forth. And they have now provided for a limit of between 5 and 10% for private equity, which now means that a scheme can, without the express approval of the authority and within the investment guidelines issued to the asset manager, then allocate into private equity funds as a limited partner or as an investor, which I think is
so
great.
You cannot make direct investments. It has to be you only make investments to an existing private equity fund.
To an existing private equity fund. That wasn't there before.
All right.
So that certainly now becomes a good space to allocate money into, particularly because of the diversity that it then brings.
Okay.
We have 60 companies that trade on the stock exchange. Perhaps it's 20, truly, that a lot of investors focus on.
That's true.
But we have tens of thousands of Kenyan companies out there that are doing very well, good management, good business models, that will never list on the exchange.
Yeah,
so truly, how do you get access to them?
That's true. Okay.
If you then don't get, participate in the private equity space.
Okay.
If you look at real estate, the average scheme, according to the latest Retirement Benefits Authority report, has got an allocation of 20% in property.
Oh, interesting. Actually, it will be higher.
That's right. So it's 20%. Many are at 30. Many are even beyond the regulatory maximum.
All right.
So many are at 20 because of the problem that I've just described.
Yeah.
Too much money. You cannot stick everything into equities.
Okay.
So they then go off and sort of invest into real estate.
All right.
And the real estate, of course, it comes in different shapes, different sort of sectors, at different levels of performance. And now we're beginning to see a much more professional and institutionalized approach in as far as investment into real estate is concerned.
Okay.
The other thing that we are now looking at, particularly as Britam asset managers, is energy and infrastructure.
All right.
We think it's a great space, particularly in terms of income-producing infrastructure, so we're really taking on board the risk.
Yeah.
And that's why in January we made an investment as Britam into a power plant.
Yeah.
Okay.
It was an income-generating power plant, already tested and commissioned. It had 18 years left on the PPA. And really, we're very happy with the sort of tariff and the guarantees that we then saw behind that.
What's the kind of IRR that you're looking at in this particular project?
And
if that's public?
No, that information is public. To be honest, it's a double-digit dollar IRR.
Okay.
So to be honest, we're fairly happy with that.
Oh, that's pretty good.
Absolutely.
That's pretty good.
So from the point of view of our investors, a good currency hedge, but also a good and safe and stable parking place for the cash. So alternative investment certainly is an area that is beginning to grow. For now, it forms a very tiny sort of proportion of our portfolio relative to the overall size, but in time it will grow.
Okay. Yeah. I mean, if I just bring us back to just the asset allocation, because I think I like how you've said, you know, RBA says you can do X% in private equity, X% in real estate, fixed income, and as well a certain amount in equities. So when you look at your asset portfolio allocation as Britam, where are you getting the highest return? And where is the largest chunk of your volume actually invested?
Okay. Our best performing asset class over the last, let me call it 2 to 3 years, has been fixed income.
Okay.
And that possibly is where we invest up to 2/3 of all our funds.
Okay. Wow.
On average, sometimes even more. And of course, you then look at the different durations, you know, 1-year bonds, T-bills, 10-year bonds, you know, X, Y, and Z.
All right.
We also are what I would call significantly invested in equities.
All right.
Sort of what I would call a significant minority. So certainly below 30%.
Okay.
And but I think there, as I described earlier, it's more around defensive plays and so on and so forth, because you really cannot you cannot afford to sell out of equities completely, because you do need a risk asset in the portfolio to then take advantage of the turn.
Yes.
But at the same time, you cannot then say you have half of your fund allocated there.
Exactly.
If the asset class has been negative for 3 out of the last 4 years.
All right.
A lot of the corporate bonds that we invested into are now maturing.
All right.
A lot of corporate bond issuers issued their bonds in 2012, 2013, and 2014. Yeah. So 2018, 2019, and 2020 are the maturity dates, and we are tracking those closely.
All right.
So for many portfolios, you know, you're talking about sort of 10-15% into corporate bonds. That is now sort of whittling down, as you know, obviously, as we then have a dearth of new issuers sort of come to market. Okay. So that's what I'd call the overall sort of makeup. You know, sort of private equity is sort of 0 to 5%.
Wow.
Yeah.
Cash generally for us is not an asset, so we can't really say to our customers that we've invested in deposits.
Okay.
Because truly that is something that they can achieve
by themselves. That's very true.
So it really is just a way for us to manage what I'd call surplus liquidity.
Okay.
But can tell me, you talk about corporate bonds. I mean, it's a dead market.
Right.
It's a dead market for now. How do you get the corporate market back up running?
That's tough.
Yeah.
That's a tough one, George.
Yeah.
In my view, it will take a combination of what I'd call institutional memory loss.
Yeah.
So what you're saying about 10 years, 10 years, give it 10 years
right.
after the next election
institutional memory loss.
Next election. If the next election goes well, then maybe.
And also what I'd call a fundamental relook at the structure of a corporate bond.
Yeah.
Because truly this is a junior, unsecured, subordinated instrument.
Yeah.
So you are really paid after the janitor has been paid. So truly, why would one invest in a structure like that? Yeah. So that, in my view, also needs a bit of a relook, just to be able to provide the right level of comfort to investors, that when things go wrong, truly, there's some level of protections that you are afforded. If you do look at the current corporate bond, then we call it defaults that we've seen.
Yeah.
For a lot of the bond investors, they've been put right at the back of the queue.
And that
has not been an interesting message for investors.
Yeah.
Not at all. So until those two issues are sorted, which is really confidence and then the structure, I kind of see that market moving sideways for.
So as a fund, as a portfolio manager, look at additional enhancements.
Yes, we'll look at additional enhancements, or originating and participating in deals on a bilateral basis.
Okay.
Where you can be able to negotiate in your own protections, negotiate in your own structure, and so on and so forth.
So a little bit more work needs to be done there before it becomes something that you put your money in.
Absolutely.
Let me just tie this back to the asset allocation story that we were actually having. So I know you are the third largest fund manager. Where are your investors getting money from, and what are their preferences? Do they prefer a standard guaranteed return?
Right.
Are they open?
Right.
Maybe just that as we help just close up this conversation on asset allocation and the element of actually using a professional as opposed to being your own professional if you're not invested in the space.
Absolutely, The Capital Markets Authority, who's our primary regulator, does not allow asset managers to provide guarantees or underwrite any returns off the back of the products that they then issue in the market. So in summary, there are no guarantees. We trade on the basis of our brand equity, distribution, and investment performance. So there's really no guarantee in there. And that message cuts across both the institutional and the retail sort of investment base. For a lot of our institutional, or rather, let me start with the retail. A lot of our retail investors for now are predominantly focused on money market type strategies. That tends to be the primary allocation strategy. And these tend to be investors who then want to earn more than they would ordinarily earn than money that's sort of placed into a bank deposit. So money market funds, those tend to do very well. If you look at the entire unit trust industry, I believe it's close to 70%, perhaps 80% of all funds are actually following some type of money market strategy. If I look at the equity side, this is a very, what I'd call disintermediated market. So that in summary means that investors don't go through intermediaries, they don't go through mutual funds or fund managers. The market structure allows them to buy equities
for
by
their own
themselves.
portfolios.
So even with 100 shillings, one can call himself an equity investor.
Brilliant.
That typically doesn't happen in more developed markets. Look at places like the US and so on, you need to have some $50,000 before you can
before you can start talking to you.
Before you can then qualify.
But we don't take advantage of that, but that's a discussion for another day.
Absolutely. So, we've seen a lot of equity investors sort of burn their fingers. Lose a lot of money with respect to equities and so on and so forth. So in my view, there's a lot of value through going through let me call it a regulated fund manager who can take advantage of professional research to make the right decisions, who can be able to provide you with liquidity as and when you require it from your investment, and so on and so forth. So truly, those are the things that I would urge investors to consider as they then allocate what I would call long-term funds into the market.
Okay. Right. Ken, it's been great having you.
Thank you.
It's a very stimulating conversation.
Absolutely.
From Kenneth Kaniu, the CEO of Britam Asset Management, and we leave you with market close statistics and see you tomorrow.